Hi everyone, my name is Shankar Nath and welcome to this episode of Matlab No Relax. Something eventful happened last month. Now I won't call it a surprise as the Ministry of Finance has been throwing quite a number of googlies over the past few years, and this one came on the 23rd of March as an amendment in the Budget Finance Bill. To cut a long story short, this amendment is likely to increase our taxes. And to talk about this in greater details, I'm joined by my four esteemed guests for the evening. First up, we are joined by Mr. Kailash from Chennai, who is a banker by profession. From the city of Mumbai, Mr. Mahadev joins us, who is a prominent figure in the mutual fund industry. From the insurance and pension industry, we have Mr. Sadashiv. And from Shimla, please welcome Mr. Vishwanath, who is a respected financial planner with over 20 years of experience. Welcome, gentlemen, and thank you so much for making the time today. So this amendment has shaken all of us, and as an investor myself, I look forward to this August almost holy gathering of representatives from different financial sectors to help us understand, appreciate and improve the situation we find ourselves in. I would request all viewers to watch this episode until the very end because there will be these small nuggets of wisdom our experts will provide throughout the video, and you don't want to miss out on any of that. So let's start with Mr. Vishwanath, and sir, I'll appreciate if you could quickly explain this amendment for the benefit of our viewers. Alright, so before this financial year, taxation on debt mutual fund schemes was done on the basis of the holding period. So if units were redeemed on or after the completion of 36 months, then your profits were labeled as long-term capital gains, and these were taxed at 20%, and they also came with indexation benefits. Now, as it stands from the 1st of April onwards, and specifically for mutual funds that have less than 35% in equity, the tax rate is no longer 20%, but investors have to pay tax per the marginal rate, that is their respective income tax slab. And B, that benefit of indexation I referred to, well, that too has been withdrawn. In other words, now there is no concept of short-term and long-term capital gain in debt funds. So whatever gains you book on your debt funds, well, that has to be taxed per your income tax slab. Understood. So Mr. Mahadev, with these new rules, what is the taxation structure within mutual funds now? Firstly, thank you, Shankar, for inviting me to your show. It's got a very interesting title, Matlab No Relax. So what I'm going to say next is definitely not going to relax your viewers, because effectively there are now three categories of taxation with respect to mutual funds. The first set of capital gain taxes are for equity oriented schemes that have a minimum of 65% in equity. In this case, the tax on short term capital gain is calculated at 15% and the long term is at 10%. Secondly, for schemes where the equity portion is between 35 and 65%, which is where many hybrid and balanced funds come in. So for these schemes, tax on STCG is calculated per the marginal tax rate, while LTCG tax is at 20% and comes with indexation benefits. So the older structure continues for these funds. And finally, we have schemes that have less than 35% in equity, and in this case, all capital gains, whether it is long-term or short-term, it is all calculated at the marginal tax rate. So this third taxation block is what this new amendment has added, and this applies to a range of funds, which includes your liquid funds, ultra short-term, gilt funds, target maturity funds, conservative hybrid, and even gold funds, and also international funds. So this is the new taxation structure for mutual funds. I'm sorry, why would a gold fund or an international fund be a part of this? I mean, especially for international funds, almost all of them are equity funds, which means the proportion of equities is definitely more than 35%. You see, the amendment doesn't say equity, it says domestic equity. And by that precise definition, international funds don't make the taxation cut. But your point is certainly valid, and I think the exclusion of gold and international funds is purely collateral damage. I mean, if the government's intention of this amendment is to tax interest income in any form as interest income and not as capital gains, then gold funds and international funds have nothing to do with interest, and they should ideally have been excluded from this amendment. Now, I don't know if the Ministry of Finance will have a rethink on this, but I certainly hope they will at least give it some thought and make some exceptions for gold and international funds. I hope so too. Now, Mr. Vishwanath, you mentioned indexation, and I could figure that it has some impact on the taxes. But tell me, is it like a big impact for debt fund investors? Okay, so very quickly, the role of indexation is to cushion the impact of inflation. Actually, not just cushion, its job is to almost eliminate the impact of inflation. Here's an example on how it works. So say I invested a lakh of rupees in a debt fund in 2017. Now there is a concept of cost inflation index, and let's say it was 100 in the year 2017. And since then, the inflation in the country has grown by around 6%, which means this cost inflation index would have increased, and let's assume that's at 140 for the year 2023. Okay, so this 1 lakh investment has grown to 1.6 lakhs by 2023, which gives us a gain of 60,000 rupees. Now, per the new system, I would have paid tax on this 60,000 rupees, and at a 30% marginal tax rate, this comes to 18,000 rupees. But per the old system, my tax would have been a lot lower because firstly, it would have been calculated at just 20%. And secondly, the indexation benefit would have kicked in and reduced my tax outgo. So in numbers, what was just 4,000 rupees in long-term capital gain until the last financial year is now 18,000 rupees, which in my opinion is a big difference. At this point, I'd like to point out that I have ignored surcharge and all that stuff just to simplify this example. No, of course, I got it. But tell me, who does this affect the most and who should not care much about it? Well, investors who are in the higher tax brackets, for them, this amendment is a problem because this now applies to all future MF investments. But if you're in the 0 to 10% income tax bracket, then you're not affected as much because even after indexation, your net tax liability would be somewhere around that same number. So if you're making your debt fund investments for a short duration of less than 3 years, then again, this new tax rule does not really impact you because you were anyways prepared to pay LTCG tax at the marginal tax rate. So yes, when one looks at this new tax rule, I think that split between your short-term and your long-term debt related goals is very important. It sure is important, and let's get Mr. Kailash into the discussion. So sir, all this is very new and very sudden for investors, and the big question is, what happens to my existing debt fund investments? I mean, will taxes be calculated per this new structure on it? Yeah, hi Shankar. So firstly, the question of capital gain tax on your existing debt fund arises only when you sell any of those units. Which means if you don't sell any mutual fund units, you don't have to pay capital gain tax. And secondly, the new taxation rules apply only to fresh investments that are made on or after the 1st of April 2023, which again means your existing investments are not impacted with this rule change and will continue to be taxed at 20% and will also receive indexation benefits. So if you have any existing investments in debt mutual funds, then do hold on to them for as long as you can because these are now a lot more precious, at least from a taxation point of view. Will do, but why do you think the government has done this? And I'll request Mr. Sadashiv for his opinions on this. Well, the most obvious reason for doing this is to plug this loophole where HNIs were taking advantage of this 20% plus indexation clause. And to put it in indicative numbers, they were paying a long-term capital gain of just 8%, maybe 10%, while the tax on fixed deposits went as high as 34%, including surcharge. Of course, and with due respect to Mr. Kailash, there will be many conspiracy theories that the banks and insurance companies have done this, but in my opinion, it's clearly this loophole that the government is trying to plug here, and the government has been aggressively doing that in many cases for the last 3-4 years now. Incidentally, I also read a tweet by Mr. Manoj Nagpal where some source of his in the Ministry of Finance gave a slightly different logic to this. You see, the government provides a capital gain tax benefit when there is a risk involved, and earlier mutual funds, debt mutual funds, had two kinds of risks in them, that is the interest rate risk and of course credit risk, and that's why investors receive those LTCG benefits. But now many debt fund categories like the Government of India bonds come with no credit risk, and many other debt funds are structured such that there is no interest rate risk in them, and they even give an indicative return, which means the nature of debt funds has changed from a market return product to a low risk, somewhat fixed return product, and that's the explanation that this person in the Ministry of Finance seems to have given. I know for many investors this is a very shaky argument, but these are the two speculations that are floating around on why the government made this change. So Mahadev does this, and apologies, I'm using a rather harsh word for dramatic effect, but does this mean the government has killed the debt mutual fund industry? Okay, let me take you a little back in time, and I don't know how many of you will even remember this, but in the year 2014, the government had increased the holding period and the taxation structure for debt mutual funds. So prior to 2014, debt funds were taxed at 10% and the holding period was 1 year, which was then changed to 20% and 3 years. And understandably, there was a huge hue and cry about it. And even people like me, we were going on television and saying that the government wants to kill the debt fund industry and all that stuff. Fortunately, none of that happened and the AUMs continue to rise. Now, why everyone is saying stuff like this now is because there is a level playing field between fixed deposits and debt funds, at least from a taxation standpoint. But from a product standpoint, I believe debt funds continue to have a decent advantage over fixed deposits in a number of areas. And just to name a few, debt mutual funds have products with tenures ranging from 1 day to 1 month to 1 year to even 1 decade. One can start their investment journey with just 500 rupees. You can move in and out of a debt fund at any time. Instead of investing in a single bond or a single bank, debt fund portfolios are a lot more diversified. And this flexibility is very important to get one's asset allocation right, which I think is something Shankar had explained in a previous video on his channel. Now, specific to taxation, in the case of bank FDs, one has to pay tax every year on the interest earned, irrespective of whether you use that interest or not. Additionally, the bank will also deduct TDS on the interest paid. However, debt mutual funds are not taxed on accruals. Instead, your gains are taxed only at the time of redemption, which effectively means the investor ends up making a higher post-tax return over the long run, which happens due to the compounding effect of holding on to those taxes. In numbers, this can fetch you anywhere from 15 to 20% additional returns over the next 20 years as compared to what a fixed deposit might have delivered, making debt funds a lot more tax efficient. In addition to returns, many investors use tax loss harvesting to offset capital gains with temporary losses, so debt funds are very useful for that as well. So overall, from a product perspective and even from a return perspective, I think debt funds are extremely attractive. In fact, I would make my case that debt mutual funds are the best vehicles to serve an investor's short-term debt needs on account of the flexibility it offers. Plus, it's commonly seen that banks offer a rather low interest rate on small tenure fixed deposits, while a debt fund makes no such distinction and one can easily get better returns from it. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. Thank you, Mahadev. Mr. Kailash, if you would like to respond to this, please. So I don't have the latest numbers, but just to give everyone some idea and probably an opposing view. So today, if there are 100 rupees that retail investors have invested in different fixed income instruments, then fixed deposits has about 55% of that amount, while debt mutual funds would have 9, maybe 10%. Now, I'm not saying this to present fixed deposits in a better light. No, that's not the intention. But what this indicates is that the Aam Janta continues to be attracted to fixed deposits for 3 simple reasons. One, it is extremely safe, and on top of that, the DICGC, that is the Deposit Insurance and Credit Guarantee Scheme, ensures the principal and interest up to a maximum of 5 lakh rupees. Number 2, everyone is familiar with what a fixed deposit does for them, and believe me, before all this SIP came in, the recurring deposit in a bank was the first and original SIP, which was then followed by our friends at the post office. And point 3, why people prefer fixed deposits is because, and this is just me speaking, but I think the debt fund industry has only complicated matters by using words like CAGR, IRR, maturity, yield to maturity, duration, interest rate curve and all that mumbo jumbo. But yes, on the subject of tax, I agree that in the case of FDs, tax needs to be paid every year and there is TDS. And yes, it does reduce your returns. So my take is, unless you put in the time to understand which debt funds are safe to invest in, whether there is any credit risk or interest rate risk, what is the YTM, etc., until then, it's probably better to go with a fixed deposit. So how important is taxation when selecting a fixed income financial instrument, Mr. Vishwanath? So yeah, taxation is an important one, but it is definitely not the only factor. And Mr. Kailash and Mr. Mahadev have already talked about it at length. In fact, taxation is just one of the 6 parameters that we use to evaluate debt funds for all our clients. So other than taxation, there is the goal, the tenure, the expected returns, risk, which is both in terms of volatility and potential loss of capital, and of course there is the client's liquidity needs. So instead of picking variables in isolation, it's my suggestion to all investors that they should first map out all the available options and see what works best for them. And I hope everyone does this exercise, because one of the problems I foresee from this amendment is that it can potentially increase an investor's risk profile. Very interesting. Can you elaborate this last part a bit, please? Yeah, sure. You see, conservative investors who are used to receiving a post-tax return of say 7% might not be able to make as much. Some may make 6%, others might be even lower than that, which means to compensate, these investors will be forced to try out more riskier investments in the form of equity or a high yielding bond, etc. The problem with doing this is that it completely disturbs the investor's asset allocation, and he or she will always be in a zone of discomfort when it comes to wealth accumulation. So that's something investors should be very careful of, and they might even have to look beyond standard solutions to rectify this financial mismatch. Alright, the next and probably the most sought after question is, what are the options available for average investors in light of this new tax law? And we'll go one by one, starting first with Mahadev. Yes, so I think the point on increasing risk profile, which Vishwanath had just raised, is a very relevant one. And I'll take some cues from there to discuss some mutual fund categories that investors might be keen on exploring. The first one is hybrid funds. And as you are all aware, there are conservative hybrid funds, balanced hybrid, and of course, aggressive hybrid funds. Now, because of this new tax rule, all 3 hybrids have a different tax structure in them. And while ideally a conservative investor should have gone for a conservative hybrid, and I would still want the investor to stay within that box, the next best alternative within this category then is the balanced hybrid fund. I should mention here that there are very limited schemes in this right now, but we can now anticipate AMCs to launch more funds in this subcategory. Another type of fund an investor can look at are arbitrage funds. These funds are unique because while they have a risk and return profile that is similar to a debt fund, but because the way they are constructed, they receive an equity fund type of tax treatment. Now, generally arbitrage funds are used to park money for a period of 6 to 9 months, and I purposefully use the word park rather than invest because arbitrage funds are a bit volatile. I mean, you're not likely to lose money in them, but these funds sometimes would deliver as high as 9%, and at other times they can go as low as 5, even 4%. On an average, arbitrage funds pretty much deliver the same returns that you can expect from a liquid fund, that is a pre-tax return of about 6%. And finally, there are equity savings funds, which holds 65% of its assets in equity and therefore is pretty tax efficient. But the 65% in equities is actually a combination of hedged equity holdings, which is a strategy that tries to limit the market risk that these funds carry. And secondly, there are unhedged equity holdings, which are the normal stocks that mutual funds anyways hold. Now, generally, this unhedged equity portion of these funds, which is where the risk really lies, can be very variable, with different AMCs having a different percentage at different points of time. So although it's not a perfect solution, it's definitely one way of moving from a potentially 30% taxation to a much lower 10% LTCG taxation. But remember, this does change the investor's risk profile, as there is a decent amount of equity now introduced within the portfolio. Okay, now other than these 3 choices, that is balanced hybrid, arbitrage and equity savings, I've read a few articles where the authors have suggested using a balanced advantage fund, or as it is commonly called, a dynamic asset allocation fund. Honestly, I'm not comfortable with this because a BAF is not really built around a risk profile, but it is more designed around a valuation model. What I mean is, depending on where the markets are, a BAF can go as high as 80% in equities, which is totally opposite to what a conservative fixed income investor is looking for. Another problem with BAF is that all AMCs apply their own distinct and different valuation model. So while one fund's model might say 40% in equities, another BAF might be having 70% in it. So in my opinion, it's better to avoid balance advantage funds as an alternative to debt funds. Thank you, Mahadev. And now let's understand our options from the banking side. Kailash, over to you. So one option investors can always explore is a high interest yielding bank deposit. Now this might seem a little obvious, but the fact is most people have their fixed deposits and savings account in a single bank. And if that's a State Bank of India, HDFC, ICICI sort of institution, then the interest one receives is on the lower side. So one way of improving your post-tax return is by improving your pre-tax return, which is possible by exploring other banks which are offering a much higher deposit rate of interest. In fact, and as I've mentioned it before, the DICGC offers an added layer of protection of 5 lakh rupees for your principal and interest. Now, the good part is that this deposit insurance coverage applies separately to each bank, which means you can lock in 3 lakhs at 3% for 5 years in Bank 1, another 3 lakhs at 7.8% for 5 years in Bank 2, and so on. And by the time that FD matures in 5 years, your account balance will still be within 5 lakhs and your capital will be totally protected. Other than fixed deposits, I strongly recommend every investor should maximize the tax-free options that are available to him or her. So this includes maximizing your PPF, which can go up to 1.5 lakhs a year. There is always EPF, which is something most salaried individuals opt for. And then there is NPS, on which there are no limits to the number of times or the amount one can contribute. So even if you don't do anything, please ensure that you have maximized your investment in these tax-free options. Thank you, Kailash. Now, insurance is an industry that seems to have brightened up a bit since the last week, and I'm really looking forward to Sadashiv sharing some options that the insurance industry has to offer here. Over to you, Sadashiv. Thank you very much, Shankar, and thank you everyone for sharing your knowledge with me and others. Yes, the insurance industry has a lot to offer, and I can put forth 3 options that an investor can consider. The first one comes in the form of traditional life insurance plans. Now, the general notion is that these plans offer poor returns somewhere in the vicinity of 5 to 5.5%. But to build more specificity, one, this IRR number depends on insurer to insurer, and there are some products that offer a number that's even higher than 7%. Secondly, the maturity proceeds are tax-free subject to some conditions like the amount of annual premium paid. And thirdly, insurance contracts are long, which means you can lock in this return for a decently long period of time. Of course, investors need to do some work here, which includes comparing different plans, clearly understanding the terms and conditions, etc. But my advice is for you to not ignore this just because it is insurance, and please keep an open mind about it and do a lot of research. A second product option the insurance industry offers is a debt ULIP. Now, I know the word ULIP can be counted amongst India's most infamous abbreviations, but look at it this way. Here's a product which is tax-free at maturity for annual premiums of less than 2.5 lakhs. It comes with a 5-year lock-in, which you can continue or discontinue as you wish. ULIPs have now moved away from the old corrupt practices, and many of the plans come with zero premium allocation charge, zero admin fees, etc. And finally, ULIPs are very flexible instruments and allow investors to allocate their capital across debt and equity in any proportion they desire. Again, you might have that overhang that ULIPs are the big bad wolf, but my sincere admission is keep your mind open, listen to the wolf and see if he has something good to offer you. And the third and final product the insurance industry can offer are annuities. So annuities, or pension plans as they are called, are not just for retirees, but it's something people in their 40s and 50s can also purchase. And the idea here is simple. You invest some money during the accumulation period, and from a future date, you receive regular payments as long as you live and for a fixed period of time. Now, specific to today's topic of discussion, annuities provide 2 distinct advantages. Number 1, it helps you lock an interest rate not just for the next 5 or 10 years, but for your entire life, which, believe me, can be quite comforting to a lot of people. And secondly, the corpus that the annuity buyer accumulates during the vesting period is exempt from taxes. Of course, I should add that the annuity payment itself is taxable as per the current laws, but maybe as a retiree, your income slab will be a lot lower than what it is now. Again, this is something investors should read up more on, understand it, and then act upon it. So these were the 3 products I wanted to share today, and I hope you found it useful. Yes, absolutely, Sadashiv, and thank you very much for this. And since Vishwanath is someone who actively works with the banking, mutual fund, and the insurance industry, I'll request him to put forth his thoughts, suggestions, and those useful tips that he often shares on social media. Go ahead, Vishwanath. Perfect. So between Kailash sir, Mahadev, and Mr. Sadashiv, a lot has already been covered. But I have a couple of tips that I think the viewers might find interesting. The first one is for anyone who already has some debt fund in his or her portfolio. My advice to them is please set up a new folio for any new debt fund investments. And the reason I say this is very simple. You see, mutual fund redemptions work on a FIFO basis, that is first in, first out. Now, your existing debt funds, the ones that you've bought prior to the 1st of April 2023, now these funds are still on the 20% plus indexation structure. And ideally, you want to kind of not redeem these as long as possible. So just in case you need to sell a few units, you'll be better off selling it from the investments that you make post the 1st of April. And that's why you should have a new folio so that the redemptions don't happen from your older stash. My second tip, and I think I've touched upon it before, is to avoid making asset allocation decisions on the basis of taxes. You see, debt is just one part of asset allocation, and by making ad hoc moves like increasing your equity by 20% or reducing your debt exposure, etc., it is only going to increase the risk, the volatility in your portfolio without giving you any demonstrable increase in returns. To put it simply, don't spend so much time on taxation, but instead spend it on improving your asset allocation. So these were a couple of things that I wanted to put across. Great. Thank you so much, Vishwanath, Kailash, Sadashiv, and Mahadev for your time and for generously sharing this knowledge with me and all our viewers. And viewers, if you have any questions, then do type them in the comments box below and I'll be happy to coordinate with our experts and find those answers for you. Please do share this video with your friends, do press the like button. I wish all of you the very best this financial year and I'll see you 3 days from now. Until then.